Emerging markets have been battered by what Steen Jakobsen calls a debt-induced perfect storm of a dizzy US dollar and crumbling commodity prices. There is now some hope, though, in Q4.
The perfect storm has been conditioned on a very strong dollar, in my opinion. And the risk to the scenario that we already seen the perfect storm, of course, is that the dollar will continue to strengthen. And the latest sort of information the market has been giving is, of course, a Federal Reserve, which is relatively unclear on what they want to do. They telegraphed that September would be a hike. And in September, all of a sudden, they start including international conditions, which of course feeds back into the same top line news, which is that the emerging market, which is 60 to 70% of world growth, is behind schedules to deliver. And as such, we have a circular argument. If you get one part of the circle right, you also get the other part of the circle right. So I think the bigger risk here is that if the perfect storm is not already over, it will be on the condition that the dollar will continue to strengthen, and that is most likely to happen in an environment where we're still waiting for the Federal Reserve, pretty much as waiting for Godot, something that will never happen probably.
The big question for investors, to what extent is this a huge opportunity now in Q4?
So of course, emerging market is more volatile, and buying right now is a more and more uncertain time in terms of what is the next direction of the dollar, what is the next move on interest rate from the major central banks. But having said that, you have the advantages in emerging market that it's both cheap in terms of price and in valuation. So its price is against what it's been on average, and there it's extremely cheap at 3 standard deviation cheap. In terms of value, you look at a bottom-up analysis and you look at what is the earning power, what is the impact, and what is the incoming changes to the market. So I'll say emerging market is unique in the sense that it is both in terms of price and valuation cheap, and you have certain markets like Russia where the dividend yield is higher than the PE. In standard-sized markets, that means that you have a huge upside, of course, because you're basically being paid to carry the position in a very high-risk market. So yes, it is very risky, but it can also be very risky to be in developed market, as we've seen in Europe with Volkswagen, the auto industry, Glencore, and the like. So I think overall, equity investors need to adjust for equity in emerging market being more volatile, but it's not significantly higher risk if you do it in a proper sizing.
Steen says over the coming months, the dollar's strength is about to be significantly tested. Now, that could be good news for emerging markets this quarter.
Traditionally, if you look at less developed market, the one asset that gets set free or liberated first or trades under normal market condition is the foreign exchange, because the foreign exchange, of course, is the lever with which the government is trying to impact its policy domestically. So very often foreign exchange is far more liquid than the bond market, and the bond market is normally more liquid than the equity market. And that has to do with the structure of the emerging market. Basically, first you have a currency which you trade with overseas countries, and then you develop a debt structure, which means that you have a corporate bond and a government bond market, and then you have equities, which means that you have a local stock exchange that to some extent is able to provide for the companies to get access to capital. Of course, very often the first step in the equity side is that they go overseas, so you will have a small country, a small stock market, but the bigger corporations will go overseas to register. A case in point would be South Africa, of course, a massive country in terms of population, but a relatively underdeveloped equity market. And most of the companies, even listed in Johannesburg, have a dual listing because they want to have access to international investors. Everything being said, that means that foreign exchange trades pretty much at least 12 hours a day, and very often 20 to 24 hours a day, 5 days a week, becomes the more liquid asset. And in terms of academic studies, as I point out, most of the return actually in emerging market, when you are long emerging market, do actually come from the FX component and less so from the equity and bonds. The ratio on average is about 80 foreign exchange and 20% the underlying asset. But of course, there are great individual stories, both in equity and in debt financing in these countries, which can be an additional sort of butter on the bread if you want to do that. But foreign exchange by far remains the most accessible. Take China. Anyone can change the Chinese currencies offshore, but not everyone can change the domestic market.
Steen has argued for many months, if not years, to get growth we need fundamental change. We're still waiting for so many things. But
My first step is always to go foreign exchange first. So over the last week, I've actually entered into long position of South African rand as one market, as I believe the Federal Reserve is clearly seeing a closing window in terms of the opportunity to hike rates. And I think that will be probably the surprise for the balance this year. So I've accessed and sold dollars and bought South African rand, and I'm also looking to do Brazilian real later this month if the trend is confirmed. So basically, I use the foreign exchange. Underneath that, I will, especially in the mining sector, start to buy companies in Brazil, where you have excellent major stores being sort of treated like good companies being treated like as the country is being treated as trash and junk bond status, but underneath that you have grocery stores, you have utility companies, which are free cash flow, positive driven, has been making money. Even the banking sector in Brazil, some of the banks has been around for 50, 60, 70 years, owned by families who's always been looking after their own interests. So I think you have to be very, very selective, but there are great opportunities also in equity. But always first enter the foreign exchange trade.
Steen's advice for the fourth quarter: embrace the volatility. It's certainly coming.
The volatility is a function of the market starting to come alive again. It becomes a two-way marketplace where there are buyers and sellers. For a very long time, the only buyers in the market has indirectly been the central banks and through the central bank's government intervening, trying to say tomorrow will be a better day. So when we see an increase in volatility, it also means the market is more transacting, and it probably means that volume will start to pick up, spreads will widen slightly. But that is a positive sign. It is also, of course, a sign that we are at the end of the business cycle and probably will see some more noise and more back and forth sorts of trading. But overall, it's a very good indication to my mind that the market is coming alive again. And the model is that the only thing you need to learn in business school is that markets should allocate capital to the marginal cost of capital. Marginal cost of capital means you should only invest in things that have a positive return over time. That didn't happen for the last 7 years. It became very much a game of buying back stocks instead of investing in CAPEX. Everything being equal, CAPEX should have a higher utility function for society and shareholders relatively to just buying back stocks and preserving value short term. So you can buy back stock 1 year, 2 year, but overall a company should be able to find investment projects that are interesting. So everything being equal, again, having said that, I think it's positive. It creates a more nervous market, but the nervous market is an indication that we have a business cycle who is re-engaging.
There's more from Steen in our Essential Trades publication, and follow him on Twitter. Look for the hashtag SaxoStrats.